everyone, I'm Gloria S, Crump, the Queen of Real Estate. Thank you for joining us this week's Tea and Crumpets. Today I have Lori Cheney. She is an attorney and she is an expert in 1031 tax exchange. She's got over 25 years of experience and 30 years experience plus just being an attorney.
Yes.
Yeah. So we're excited you're here. We have lots of people that I deal with a lot of 1031 tax exchanges, and a lot of people ask questions.
Sure.
And I always refer to the experts. So
Yes.
thank you for coming and
I appreciate the opportunity.
represent clients of ours.
Yes.
You do a wonderful job. So, so start off with just the basics. So what are the qualifications for a 1030, or what is a 1031 tax
Okay, so a
exchange?
1031 tax deferred exchange is a vehicle by which an investor who's held property, obviously for business or investment purpose, can sell that property and then acquire replacement property and defer the gains that they normally would have to pay to the government. They can keep that and be able to infuse it into the replacement property, therefore giving them more buying power.
And just deferring the
Taxes,
taxes
correct.
on the profit. So
That's correct.
Gotcha.
So where you normally would pay tax on the gain, that you can actually, that portion in effect is an interest-free loan from the government, because you get to use that portion, the 20% roughly that you would have to pay the government, you can use that portion and infuse it into the replacement property, thereby giving you more buying power.
Perfect. Now, what are the qualifications of a 1031 tax exchange? Because a lot of times people that have second homes here,
Sure.
they don't rent it out, they just automatically
Right.
go, I'm going to do 1031 tax exchange. And I say, have you rented your property?
Unfortunately, that won't qualify the
Yes.
pure second home. You really have to, it has to be property that was, okay, thinking about this is all accounting, right? Because we're dealing with the IRS. So the property has to be held for investment and be treated as an investment on the tax return. Therefore depreciated. So second homes don't qualify for that if it's a pure second home.
Yes.
You know, you had to treat it as a rental, put it in a rental pool. Raw land can qualify if you acquire it and you hold it for a period of time. Raw land can also qualify. Really, any type of real estate can, as long as it's treated as an investment by the taxpayer, especially on the tax return. That's extremely important.
Leading up to the
Correct.
sale.
Yes.
Okay. All right. And now, with that being said, if somebody does have a property here at the beach and they use it a little bit as their second home, but they also rent it out, what in the eyes of the IRS do they consider that where it would be suitable for 1031?
Sure. It'd be easier if I just read this.
Okay,
so, if the taxpayers held it for 2 years, right, already prior to the sale, then in each of the 2 years prior to that, if they rent it for fair rent, now you can't rent it to Cousin Bob for $10, right, for a fair rent, then for at least 14 days, or also there's another qualification that you may not personally use the dwelling unit the greater of 14 days or 10%. So if you rent it for 300 days, you can use it for 30 or 29 days, right?
Yes.
So the thing is, they're trying to keep people from truly using them as second homes, but saying it's a rental.
Gotcha. Yeah, they're trying to make sure the people that actually are purchasing this, deferring it, are true investors.
Right. Not that you can't use your property, and you can also go check on your property.
Yeah.
You know, you can use it in your rental role, like put yourself, block it out for 14 days or so, but it doesn't mean that you can't go another maybe few weekends to go check, do maintenance, because there are things that we have to do to our properties, right?
Yes.
So that you can go, you know, for the weekend, use your property as long as you're doing those maintenance you know, issues while you're there.
Exactly, not just like a true vacation.
Right.
Gotcha.
Yes.
Okay. Perfect. And then now let's say they didn't hold it for 2 years. Let's say it's a little shorter than 2 years.
Sure. Yeah.
What happens in this scenario?
Okay, so if the transaction was audited, what the IRS will look at is the circumstances.
Okay.
If we know that 2 years is good, the code section itself doesn't say must be held for 2 years.
Okay.
There's no time period stated in the code. So then it becomes circumstantial.
Okay.
Under the 2 year period.
Okay.
I always tell people that I definitely would hold it for over a year. You don't want to be in the same tax period, obviously, of buying and selling.
Gotcha.
Because then that's not holding. You're not going to
They're
qualify
looking at
for
that
the
as a
hold.
flipper.
Correct.
And then it
yes.
won't qualify.
Which does not qualify at
Okay.
all. Right.
And then that'll just cause a red flag.
Correct.
And they'll say,
they'll
oh, sorry.
They'll disallow the exchange.
Exactly.
Yeah.
Okay. All right, and now let's see. And that is also goes for builders, like true builders.
Correct.
They don't, even if they were to hold it for over a year,
yes,
or to even 2.
Correct.
If it's a builder,
because the IRS considers that inventory, that's professionally, that's what they do. They are builders, and so they're not investors. They're builders.
They're builders.
Right.
And it's inventory instead of investments.
Correct. Flippers don't, so if you buy a property with the intention of renovating it, flipping it, selling it, that does not qualify.
And they'll just get kicked back.
That's correct. Okay. Because it's the holding. It's meant for property being held for business.
And that's kind of...
Held being the key word there.
That I was just going to say, that seems to be...
Yeah.
And then you just... Not saying you won't get, even if you hold it for 2 or plus years, not saying you won't get audited on that, it just doesn't cause red flags. It's
right.
Because obviously there's other qualifications, meaning, did you rent it? How much did you personally stay?
Correct.
So there's a lot of...
Circumstantial.
Yes.
For sure.
Okay.
Yes.
And now what are, okay, let's just say the person, like we'll do a couple scenarios. So the person sells the property for $500,000.
Okay.
But they had to pay off, their loan.
Right.
And their profit is $300,000.
Sure.
So that's how much goes into the tax exchange, obviously, because that's the profit, the gain from just the sale. But that's not necessarily the gain in the eyes of
for accounting purposes.
For accounting purposes.
Yes. Right.
So
that is their exchange funds. Is a better way to label it. Their exchange
versus the profit.
The 300 would be the exchange funds that are coming into the exchange itself.
And so, so the $500,000 is what they would need to purchase another property for to void or to defer the tax.
To be totally tax deferred. That's correct. So the simplest way to explain it to someone really is what you sell for is what you have to buy for to be totally tax deferred. Now you can do a partial, so if you go below that, you can do a partial tax deferred exchange. But if you want to be totally, defer all your gain, you're going to have to buy for what you sold for.
Yes.
Minus certain allowable expenses.
And then those allowable expenses are...
Sure,
we have a little list.
Yeah, so there'll be your realtor fee, the qualified intermediary fee, me.
Yes.
So your filing fees associated, like the deed, the deed has to be filed, those things. Your title insurance, you can deduct that. If there's any other related attorney's fees, because sometimes exchanges, down here we're more familiar with your single investor buying and selling condominiums.
Yes.
But in other places, they're a huge commercial conglomerate. They can buy, a whole shopping center. So sometimes there's other attorneys involved that have to review documents. So those type of attorney's fees are also deductible.
Okay.
And then if there's any finder fee or escrow fees, depending on the state in which, the sale is occurring. So.
Just pretty much like a typical closing cost.
Correct.
But not anything to do with a loan.
Like your property tax prorations or not.
Gotcha.
Yeah.
Well, and dues. And like
correct.
Yes. HOA dues.
Correct.
Just pretty much what costs you incur by just purchasing or
just selling.
Correct. Okay.
Yes.
And now, and then the fees that are the closing costs that can not be used or anything to do with a loan.
Correct.
As well as taxes for the property and the homeowners.
Right, yeah. So on the back end, for what I call the back end, the replacement property, anything associated with a loan is not going to be. Okay. You can't add that in to try to get to the number you need to get to.
Gotcha.
To be totally tax deferred. Yes.
All right, and now, and if they do purchase a property for $400,000 or $450,000, then that's what's considered a partial.
Correct.
And then they're taxed on the
$50,000 in your scenario. Yes.
All right. Now let's see. We have lots of little questions. Okay, so now let's just say about if someone wants to cancel an exchange.
Sure.
They go, I had someone ask me about this. They say, I really wish that I had not put the entire, proceeds from the sale into the tax exchange because I really wanted to pay off some other things. And in that case, in that scenario, what would you advise them to do?
Okay, well, you want to back up a little bit.
Okay.
If they can have the foresight, they can hold some funds when they sell at closing, right? So you can tell the title escrow person, I want to hold out $30,000. And then, as long as they understand that it's taxable, they can hold it out at closing. So most of the proceeds will come into the exchange except for that $30,000.
And then they're taxed on the 30.
Correct. But let's just say they didn't, and then afterwards they're like, gosh, why didn't I do that, right? So after the exchange is complete, if they're going to purchase a property, the difference then can be issued back to them once the exchange is complete and they have no other properties identified now. then that amount can be issued back to them, or will be issued back to them because it's their money, and then it will be taxable. Also, if they decide they don't want to do an exchange, like maybe they're like, I can't find a property that I want, or you know what, I realize I really just need that money.
Yeah.
I shouldn't have just done it to begin with. It
Yeah.
sounded great at the time, but now I'm like, then I have to wait 45 days, or on the 46th day I can give them their money. So the 45 days is relevant to the time period. That's the identification time period for replacement properties. So on the 46th day, I can then issue the money to them.
Yeah, so like
if they have not identified.
If they have not identified. So that's
right.
Like on the 20th day, they go, man, I really need that money. I hate that I did this. I'm not going to identify anything. They still have to wait the 46th day.
Yes.
Okay.
And that they're very strict about that, and it can actually put my other exchanges in jeopardy.
Oh, wow.
If I was to, because the taxpayer is not allowed to have control over their funds.
Oh.
So you calling me going, hey Lori, I want $30,000. What that does is gives you control over the funds. And you cannot have control. That's part of what the qualified intermediary is doing, right?
Yeah.
Is safeguarding those funds in the exchange and facilitating the transaction for the exchange. So that's my primary purpose, is to do that. And according to the tax code, you cannot have control, the taxpayer can have control of their funds.
And I've had where people have sold property in other areas, and they call me and they're like, we're going to do a 1031 tax exchange. And I said, okay, well, who's the attorney handling the funds? And they say, oh, well, we don't have anybody. And I said, so you actually had your proceeds transferred to your personal account?
Right.
And they say, yes. I'm like, well, then you can't do a 1031.
Correct. I get that call probably once or twice a year where, hey, I want to do a tax deferred exchange. I'm like, okay, great. Well, when are you selling your property? I already sold it. I'm like, okay, when you say you sold it, do you have a contract, or no, we already went through closing. I said, I'm so sorry.
Yeah.
You can't go backwards. You can't retroactively do it. Once you take possession of those funds, it's too late.
It is way too late. I've had that happen before.
Oh, yeah.
And I mean, I don't like to be the bearer of the bad news, but the phone call after that just seems very somber.
And sometimes people give them misinformation. They don't know.
Yeah. I know. And so I've had that happen, and I'm like, you touched the money? Oh,
yes, right.
No, you can't.
It's taxable.
Do it.
That's right.
Yes. And so, let's see. Now, okay, so time frames, like we talked about how, the identification period is 45 days, and they do identify.
Correct.
And then now they have to close on it within a certain time frame.
Correct.
Is it a total of 6 months from the 45 days, or is the 45 days included in the 6 months?
So there's 2 clocks that start running.
All right.
And they start running on the settlement statement date, so the actual closing date. The first is the 45-day identification period, and the second is 180 days to close. So you say 6 months, but technically, because it's the IRS, it's 180 days.
180 days. I stand correct.
That's right.
Yes.
Because sometimes it can be a day or two and you're off it.
Yes, exactly.
So if you're on day 181, it will not quite.
Yes.
You're outside their exchange period.
And so, and that 45 days is part of the 180 days.
Yeah. Some people will say the 45 days, and then they'll subtract out 45 from 180 and say that's the additional. But I think it's easier to tell people your clock starts running on the day you sell your property.
And one misconception I've had where people think that they have to put a closing date period once they do identify a property.
Sure.
They feel like they have to wait until the 46th day to close. They do not have to.
No,
and that's why I tell people
you do not.
You do not have to wait that time frame. You
Correct.
can close immediately if you would like.
Right. So part of the 45-day identification is I send a sheet to the taxpayer. They can identify up to 3 properties with no value limit. There's another tax rule they can go under, it's a 200% rule, where they can identify as many as they want, but the value of all the properties they identify can't be greater than 200% of what they sold for. So if they sold for $1 million, $2 million would be their limit.
If they go above the 3
Correct.
properties.
If they go above the 3 properties. So,
but if they only identify 3 properties, it can be above the 1 million.
Correct. There's no limit at all on that. Yes.
All right, and let's see. There's a lot more. I know there's more information, but I don't want to bog down it myself, much less everybody, because we might have to do another video. Because I mean, there's just so much to it. That's why I always say you need to call.
I would tell you the one thing that I see is the biggest misconception.
What's that?
Is that people think that they have to reinvest only the exchange funds.
Yes.
So that is the biggest misconception that I see. People call me and they'll say, well, I'm getting $300,000 from this exchange, and they think all they have to do is go out and find property for $300,000.
Yeah.
And that's not correct, because we're dealing with accounting principles. In our previous example, if they sold for 500, even if only 300 come into the exchange, they have to go buy for the 500 to be totally tax deferred.
Yes.
So, and that's my biggest misconception.
And I think too, a lot of times when we were talking about a little earlier before the video, how people do depreciation costs and things of that nature. And so there's a lot more to it in that sense.
So gain is determined by, simply put, what you sell for minus your basis. And basis is created by what you bought the property for originally. But every year you get to write off a little bit of depreciation.
Yes.
Right. So that's the advantage of owning investment property, because on your tax return you get that depreciation write-off, right? But when you sell, you have to recapture that depreciation.
Yes.
So that's another good thing about the 1031, is that it allows you to be able to push that into the replacement property.
And on the depreciation, this is a question I've had where some people ask, do the condo dues and the taxes, that is not included in depreciation?
No, that's something they would write off. So when it's an investment property, you get to write those off every year. Right. So they're not capitalized and therefore increasing basis. What they're doing, that's just an expense every year.
Yeah.
You just write it on your tax return.
Yes. And I've had people ask me that before, and so that's good.
Depreciation is something totally different.
Exactly.
Right. There's a schedule that your accountant goes by that allows you to write off a portion of that property every year. And it goes against any other income, depending on whether you're actively doing real estate. There's other little tax rules there though, but depending on how deductible.
With the rental income coming in and things of that nature to help kind of offset that the taxes that are going for the rental income. So, all right. Well, I feel like, are there any other just common questions that you get about with people coming forward? I mean, I think we hit a lot.
We've hit really a lot of it. Mainly, like I was saying, the big misconception about. Some people also tell me, well, I've been told that they can't do a partial tax deferred exchange. I said, no, that's not true. You can do a partial tax deferred exchange.
And I've had people
they think it's an all or nothing. I'm like, it's not an all or nothing. Now, I will suggest, I tell people, call your accountant. They know your true numbers. I do not.
Yes.
So you need to know, when does it become beneficial to do an exchange? At what point are you deferring taxes?
Yes.
So if you sell for $1 million and you want to go buy for $350,000, you probably hadn't even reached your basis, if that makes sense. So so don't pay me to do an exchange when it's not going to be a benefit.
So they need to talk to them.
So they talk to their accountant to see where it is, the point where it becomes beneficial. The exchange really makes sense for them.
Yes, because I had a property the first time I had a client that did a partial. He sold a property for $1.3 million and decided to buy a condo for around $550,000. Right. And then he obviously, kept the proceeds of the difference. And so many people told me, you can't do that. You can't do it. I'm like, yes, you can do a partial, so you don't have to do the whole amount.
Yes.
So that is.
And some people that have owned properties here for a very long time, their basis is zero.
Yes.
Yeah. Which is crazy.
I know.
So anything they would, in that situation, anything they would purchase would be helpful.
Yes, very much so. Yeah. Well, that's awesome. Well, I appreciate you taking the time.
Of course, I appreciate the opportunity.
Yes, and so when you're ready to buy property and do a 1031 tax exchange, you can call both of us.
Yes.
And we'll make a great team. And
yes, absolutely.
Yeah, well, awesome. Yeah. And thank you for watching. I hope you found it very beneficial.